it has been confusing because Wall Street, many on Wall Street refuse to believe we're going to have a recession, but we are. We're going to have a recession because for the first time, at least in my long lifetime, the Fed has raised interest rates into a recession. And we have a phenomenon where because of that, we have the bond market declining. And at the same time, because we're going into a recession, the stock market's declining. And so folks who manage portfolios are scratching their heads and saying, where do we go? But it's pretty clear that, the first industry that is impacted by higher interest rates is housing. And housing has just been really down. Last month, the housing starts fell 8%, and they're down over the last few months at a 40% annual rate. That's huge. Those are big numbers. And the Fed seems to have ignored the deterioration in the housing market and in all the interest-sensitive markets. For example, we see that consumer borrowing is up at a huge annual rate, and that's because consumers, when you go to fill up your gas tank and it costs you twice as much as it used to, they put it on their credit card. And now banks are, when they report, they're reporting that their loan loss reserves are being increased because they expect over the next few months that they're going to have issues with delinquencies. We've also seen corporate issues where corporations are having less liquidity and they're going to have issues too. So the Fed at first said, well, we're going to have a 4% economy in 2022. Well, it's almost the end of 2022 and we're not anywhere near 4%. And so at their last meeting, they lowered it to 0.1%. That's the Fed's way of saying, yeah, we know a recession's coming. Over the last few days, so the Fed has been increasing interest rates at a very high rate, higher than, faster than at any time over the last few years, maybe over the last 40 years since Volcker. And they've been increasing these interest rates quite rapidly and seemingly ignoring what's going on in the economy. And all of this time is different in the sense that this is the first recession that we're going to have where the Fed has a new policy called transparency. In the past, when Greenspan was the chair, nobody on the Federal Open Market Committee, that's the rate setting committee, ever talked about what they were going to do or what they were planning to do. They were always silent. Beginning with Bernanke and in 2012, they started publishing the thing called the dot plot. This is where they all forecast where they think interest rates are going to be over the next 2 or 3 years. And the market takes the dot plot as gospel, even though the history of the dot plot since 2012 is that it's about 37% accurate. So it's not really very accurate. Despite that, the markets take that as gospel. And so when any of those FOMC members say, hey, we're going to tighten further, the market reacts instantly and puts interest rates to where they think the Fed is thinking, not to where the Fed is, but where they're thinking. So we had last week on Friday, a Wall Street Journal article came out. Now the Fed has its favorite people where it kind of leaks information to them. And the fellow at the Wall Street Journal published the article saying the Fed is now thinking of not raising interest rates as fast as the market thinks. So we had over Friday and Monday and Tuesday, interest rates came down significantly from where they were. The the 2-year was over 460, and now it's back to 440. So there is now, and Mary Daly, who earlier in the week, Mary Daly is the San Francisco Fed president. Earlier in the week, Mary Daly said, hey, expect us to move rates higher and keep them there for longer. Early in the week, she said that. And by the end of the week, she said, no, we're thinking about not raising as fast. Mm-hmm. Now, let's be clear. This isn't a pivot where they're reducing rates, and it's not a pause where they're stopping. So it's the next best thing called a step down.
Step down.
And as a result of the fact that markets have in this cycle have instantly moved to where they think the Fed was going. Now that the Fed is saying we're really not going there, the bond market has eased off a little bit.
Okay.
So interest rate sensitive sectors like housing are in the tank. We've seen retail sales on a real basis, this after inflation, being flat to down. And even though we are probably going to have a positive GDP print this tomorrow or Friday, mm-hmm. It's technical in nature. It's due to the foreign the strength of the dollar and imports and exports, net exports, and to the fact that corporations, because they were afraid of the supply chain issues, ordered inventory because they didn't think they were going to get it, and now they've all gotten it, and they don't really want it. So we're going to have an inventory increase that's unwanted, but it's going to show up as a positive in the GDP. Nevertheless, the economy is weakening, and I think the Fed is starting to recognize this.